What happens when a nation's debt climbs beyond all imaginable limits? We're often told, at 100% of GDP, the economy starts to suffocate. At 120%, markets get nervous. At 150%, collapse is inevitable. And yet, there is one country that defies all of these assumptions: Japan. Today, its debt stands at over 250% of GDP. And still, the economy functions, banks remain stable, and investors aren't fleeing. How is this possible? Why has Japan lived for decades with a debt burden that would mean disaster for almost any other country? And most importantly, does this paradox hide a ticking time bomb that could reshape not only Japan's future, but the future of the global economy? To understand this phenomenon, we need to travel back in time, to the era when Japan was the symbol of an economic miracle, the 1960s through the 1980s. Rising from the ashes of war, Japan transforms into one of the world's leading industrial powers. Toyota, Sony, Mitsubishi become household names. Exports fuel the growth. Banks are deeply intertwined with corporations, while the government encourages production and investment. It was a world of cheap credit, high employment, and seemingly unstoppable progress. But beneath the shining surface lurked a danger. This very system was laying the groundwork for a future crisis. And soon Japan would discover that its own economic miracle would turn into one of the most dramatic financial experiments in modern history. In the early 1980s, Japan stood at the height of its power. The economy was expanding so quickly that many believed it was only a matter of time before Japan surpassed even the United States. GDP growth exceeded 5% annually, and Japanese companies were buying up assets around the globe, from skyscrapers in New York to Hollywood studios. But beneath this success lay a dangerous foundation. The financial system, where banks were tightly bound to corporations, was flooding the market with easy credit. Land and property values skyrocketed, while the stock market soared to unprecedented levels. By the end of the decade, land prices in Tokyo had become astronomical. It was said that the Imperial Palace grounds in central Tokyo were worth more than all the real estate in the United States combined. This was a bubble in its purest form. Overvalued assets propped up by cheap loans and an unshakable belief that growth would last forever. Rather than cooling the market, the government and the Bank of Japan poured more fuel on the fire. Low interest rates and incentives for investment drove speculation even higher. Before the world's eyes, Japan was inflating one of the largest economic bubbles in modern history, one that was destined to burst. Everything changed in the early 1990s. In 1989, the Bank of Japan began raising interest rates in an effort to cool the overheated market. But the move came too late. The speculative bubble had already grown to massive proportions. Between 1990 and 1992, the collapse began. The Nikkei stock index plunged by more than 60%. Real estate prices in Tokyo crashed and continued to fall for nearly 2 decades. Banks were left drowning in bad loans, corporations lost access to easy money, and millions of Japanese citizens watched their savings evaporate. It seemed as though the nation's once invincible economy had suddenly frozen. This period became known as the lost decade, though in reality, the stagnation dragged on for far longer. The government faced a stark choice: either allow the system to collapse or prop it up at any cost. It chose the latter. And from that moment, Japan entered a new era, one defined by massive debt-fueled rescue programs that kept the economy alive, but also created the burden the country still carries today. After the bubble burst, Japan entered a new chapter of its history. The economy slid into deep stagnation. Growth stalled, unemployment crept upward, and confidence in the financial system wavered. To counter the slump, the government launched massive stimulus programs. Roads, bridges, and airports were built. Huge infrastructure projects designed to spark demand and bring back jobs. But all of this required money, and the only way to finance it was through government borrowing. Public debt began to skyrocket. In the 1990s, it crossed 100% of GDP. By the 2000s, it was approaching 150%, and from there, it only accelerated. The problem was made worse by failed attempts at austerity. In 1997, when the government raised the consumption tax, the economy fell back into recession. Whenever spending was cut, business activity slumped even harder. The central bank also stepped in. Interest rates were slashed to nearly zero, and Japan pioneered early experiments with quantitative easing, printing money to buy up government bonds. Instead of a rapid recovery, Japan found itself stuck in a prolonged era of low growth and mounting debt. Stagnation became the new normal, and public finances turned into a hostage of endless rescue programs. Today, Japan's public debt stands at over 250% of GDP, and still the economy functions, banks remain stable, and investors aren't fleeing. Why? First, almost all of Japan's debt is held domestically. Japanese banks, pension funds, and in recent years, the Bank of Japan itself own the bulk of government bonds. This means there's little reliance on foreign creditors and almost no risk of sudden capital flight. Second, Japanese households have traditionally been heavy savers. A high level of domestic savings allows the government to borrow from its own citizens and institutions. Third, the Bank of Japan has maintained ultra-loose monetary policy for decades, near-zero interest rates, and massive bond purchases. This keeps the cost of servicing the debt extremely low, even at colossal levels. But beneath this paradox lie troubling trends. The population is aging rapidly. More than 29% of Japanese citizens are over 65. Pension funds and banks keep buying government bonds to cover retirement payouts. Yet, as the workforce shrinks and tax revenues fall, this model could become unsustainable. Comparisons make the picture even sharper. When Greece's debt approached 180% of GDP, the country spiraled into crisis. In the US, at around 120%, fierce debates rage over fiscal sustainability. And Japan, sitting at 250%, seems to defy economic gravity. The real question is, how long can it last? Japan's story is not just about debt and finance. It's about how a nation managed to stay afloat despite endless predictions of collapse. But this experience carries powerful lessons for the rest of the world. 3 key takeaways. 1. Debt itself is not a death sentence. What matters is who holds it and how it's managed. 2. Economic bubbles and policy missteps can condemn entire generations to stagnation. 3. An aging population and reliance on domestic savings form a fragile foundation that may not last forever. The ultimate question remains: can Japan continue living with debt at 250% of GDP for decades to come? Or is this a time bomb waiting to explode once demographics and finances shift? Meanwhile, other nations seem to be following the same path: the US, Europe, even China. Will the Japanese scenario repeat on a global scale? Think about it and share your thoughts in the comments. Has Japan discovered a unique formula, or is it merely postponing the inevitable? Subscribe to the channel so you don't miss more deep dives into how financial history shapes our future.